Welcome to On the Money, the video series where Wilkins Miller experts share updates, tools, and tips to help your business achieve more. I'm Caitlin, and I'm on the tax team at Wilkins Miller. When I think of February, I think of Valentine's. When I think of Valentine's, I think of gifts. And sometimes, nonprofits receive gifts that can't really be wrapped in a bow, non-cash gifts. Instead of cash, donors may offer appreciated stock, real estate, or even crypto. These gifts can be incredibly valuable, but they come with some important responsibilities. For donors, non-cash gifts can be a very tax-efficient way to give. When you donate appreciated property or stock that you've held long-term, you may be able to deduct the fair market value and avoid capital gains tax. It's important to note that if the donor is giving land or other real estate, that the IRS requires a qualified appraisal. The donor must complete a Form 8283, which describes the property and provides its fair market value. The nonprofit's role is to simply acknowledge receipt of the property, not to determine its value. But after the gift is received, there are additional steps. Real estate is reported at its fair market value on the date of contribution, and it's reported on the nonprofit's tax return. If the organization sells or disposes of the property within 3 years, then they must notify both the IRS and the donor. Another issue to consider is property taxes. Whether property taxes apply to the donated property depends on the location of the property and whether it's actually being used for the organization's exempt purpose. Now, let's talk about appreciated stock. Gifts of publicly traded stock are often simpler for both sides. Donors usually don't need to get an appraisal, and they receive a charitable deduction for the fair market value on the date of the gift. Nonprofits typically sell publicly traded stock shortly after receiving it to avoid market swings, and the gift is reported on the Form 990 at its fair market value as of the date of the contribution. That brings us to digital assets, specifically crypto. We're seeing cryptocurrency gifts more often, especially from younger donors. For tax purposes, the IRS treats crypto as property, not cash, so the non-cash gift rules apply. So what's the big takeaway? Non-cash gifts can be incredibly generous and strategic, but they're not as simple as just dropping off a check. A little planning up front helps donors maximize tax benefits and helps nonprofits avoid unexpected tax, compliance, and cash flow surprises. So, if your nonprofit receives a significant non-cash gift, pause, ask the right questions, and make sure everyone understands the responsibilities of the gift. And that was On the Money.